Hello Sector Watchers, welcome to the show. This is the 192nd episode of Sector Spotlight for Monday the 25th of September. I do realize that it has been 2 weeks since we had a regular show, and that was mainly because I traveled to the StockCharts headquarters in Washington, and we did a few takes there. I did Charting Forward with Dave Keller, I did 2 shows with Ralph Acampora, so I hope you still got your weekly dose of RRG, let's call it like that. But we're back now with a regular episode, and I want to go and talk to you on what happened and what is currently the state of rotation in asset classes and sectors. Ladies and gentlemen, this is Sector Spotlight. Let's kick off with the current state of asset class rotation. So on the left hand side we have the RRG that shows the weekly rotations for the various asset classes that we're tracking here in Sector Spotlight. I'm going to pass on the daily because it's been quite some time that we talked about all these rotations. So I'm going to focus on the weekly charts and the weekly rotations and the accompanying charts belonging to those rotations. When we look at that weekly RRG, I think there's one main takeaway, and that is the current strength for commodities as well as the US dollar, maybe high yield, and the weakness once again for Bitcoin versus the US dollar. And that is all related to VBINX, which is the balanced index fund that we use as the benchmark here. So as I said, very strong rotations for commodities already for a couple of weeks. We're going to take a look at those charts in a minute. The dollar is really strengthening. Look at how that tail is now moving forward, and especially how the distance between the nodes, we call that RRG velocity, is increasing. That is a clear sign of increasing strength for the US dollar. And that also goes to a lesser extent for the commodity tails, and in a negative way for Bitcoin. These are all relatively long tails. However, the major rotation, obviously, is the one that we're always tracking, is stocks versus bonds. And if we zoom in on that, then there is an interesting observation that we can make. Obviously, it's clear that stocks have been on a weaker streak over the last couple of weeks, actually, and bonds are doing relatively well. But when you look at the RRG, and especially at the tails and the tail length, I see that SPY, which is obviously stocks, is still on the right hand side, but it is a very short tail. And the same goes for, let's use GOVD, which is the entire US yield curve, all the maturity, so the average maturity on the yield curve, is going in a positive direction versus SPY going in a negative direction. So that is clearly a rotation in favor of bonds over stocks in the near term, because it's primarily a momentum-based move, but also with very short tails. Both SPY and GOVD have very short tails, and SPY is on the right-hand side, which is the stronger positive side of the RRG, and GOVD is on the left-hand side, which is the weaker negative side of the RRG. So short tails indicate a stable trend, and on the left hand side that's a stable downtrend, and on the right hand side that's a stable uptrend. So without the tails for SPY or GOVD showing characteristics like, for example, the US dollar or the commodity tails, I have to remain with a, I think, positive bias, positive undertone for stocks over bonds, albeit that there is currently a counter move going on. So I will look at the individual chart of SPY versus IAF in a later stage when we go over the individual stocks. But the main takeaway for this RRG right now is a clear new period of strength for commodities, a new period of strength for the US dollar, a period of weakness for Bitcoin, and a temporary period of weakness for stocks in favor of bonds. That's the major rotation. So let's take a look at the individual charts here in relation to those tails. Here's the US dollar, and you can see how that is the US dollar index. This is moving into a straight line up. How that is moving since July. That's really strong, and I have to admit I didn't expect that. When we broke below this support level, I really thought that the dollar was going for a longer decline, but you know, this little flimmer of support formed by this old resistance apparently did the job. I can't really explain why, but I'll take it. And we are going through a period of real dollar strength, and we're now pushing against a new area of resistance just below 106 in the dollar index. If we translate that to the euro dollar chart, then we can see here on the weekly that we're breaking below a number of important support levels. So it's the rising trend line here that's connecting these previous three lows, but it's also below the previous low, which is the May low. And you know, if that continues, then I think the next target is somewhere around 105. If that gives way, we're going through an absolute new move lower in euro dollar. If you look at the RSI, there is a very clear negative divergence. I do realize that these highs are not particularly lower, but when you compare them to the highs in the price chart, they're all at the same level. So there's still a divergence. Price chart moving higher, RSI peaks at the same level. The chart of SPY S&P is interesting. There is a lot of debate over what is happening here and what is the best way to view this. Let me first start with a look from a relative perspective. The raw relative strength is still above resistance. We didn't really push higher, but we didn't break back below the previous high either. And if you look at the RRG lines, you can see how that red line, the RS ratio line, is still well below 100, setting a peak there, but there is plenty of room for that RS ratio line to curl back up without hitting the 100 level, and that's all dictated by the RS momentum line. And especially because that tail is so short, that there is only a little bit of upside relative momentum needed to turn this around and bring it back into the leading quadrant. And then very likely the opposite will happen with GOVT and LQD and HYG. So as I said, there is a lot of debate going on the price chart of the S&P, and I do have to bring up the daily chart for that, because there is a head and shoulders pattern here. I'm pretty happy using it as an S&P, as a head and shoulders chart for the S&P. And in that case, we broke the neckline after a big gap down. So that's all giving you a pretty negative reading on this chart. However, the longer term, and I need to go back here, there is a pretty important peak that was set in August, 431.73, let's say 430. And if you look at that on the daily chart, you can see that we are currently sort of struggling or testing or playing around with that support area. So the big question right now is which scenario will prevail? So scenario one is that we broke a head and shoulders pattern and we're ready for a move lower. If that is the case, then the target area would be, so this is 430 to 460, that's 30 points, so you'll be around 400, 405, 410 here. This area is your target area based on that head and shoulders pattern. However, if that major peak back in August holds, and if that old resistance remains support, and we're building a base here, and you can see that even today on the first day. I'm recording this after the close on Monday, and you can see that the market actually ended at the top of its range. So it's playing around with that 430 support level, and if that holds, then we could be setting a new peak and line up for a move higher. There is obviously the old support line, that now the neckline of the head and shoulders pattern that is potentially acting up as resistance. But I do think that we're in a pretty crucial area for the S&P right now. So I'm holding back of making some sort of a major call, not that I'm really fond of doing that anyway, but I think there's two scenarios here. Either we are building a base and we're setting a new low here and we're moving higher, and this is the sort of end of the correction and we're going back into our uptrend, or this is really a head and shoulders pattern and we do need more downside and we will see prices moving towards the 400, 405 area. Only time will tell. I'm going to give you a little bit of a spoiler alert. I also have a bit of a problem coming up with a super negative scenario looking at the sector rotation, but we'll talk about that in a minute. Here's my annotated chart of the S&P 500, and you can see how that 430, 431 area is now clearly being tested. The negative divergence in the RSI has kind of worked out now. We're below, what is this? This is 50, so here is 30, so we're below 50, so not really overbought or oversold anymore. We have to wait and see. That MACD is not looking too good though. The problem for the market, and I've said it numerous times in the past, comes from the bond market. And that's where the, call it confusion or kind of problems come in with reading this market at the moment, because bonds, GOV, but also IEF are breaking below support. And that's clearly a negative thing. So if you look at this GOV chart, that is breaking below support in the 2220, 2230 area, which is a negative sign, clearly. And the same is happening with IF, which is breaking below its October 2022 lows. Essentially, bond markets are giving us a negative signal pointing to higher rates. And usually higher rates are not very good for stocks. So this is something that you really need to keep in the back of your mind. It's fueling the confusion in the stock market, because stock market is not really going down. It's not really, rapidly moving lower. It's playing around with that 430 area, while bonds are clearly breaking support. So all in all, it remains a kind of a difficult situation. Look at the yield chart here. That is definitely pushing higher now. We're breaking above 425. And that sets up yields for a move higher. So this confirms that break in the bond market. That's a serious problem. It can become a serious problem in the stock market. Looking at it from another perspective is that if even a break in bonds and a rise in yields is not able to push the stock market seriously lower, I think that is that must be seen as a positive undertone for the market. We're not there yet, but you can probably hear it. I have a bit of a problem coming up with a very clear scenario. I think that the longer term readings, and especially when you bring in the sector rotation, is still pointing to a good stock market, but there are some short term problems, especially driven by the weakness in the bond market at the moment. So here is the SPY IEF chart, and what you can see here is that there is a clear negative divergence for SPY versus IEF. So this is could even become a double top, but there is clearly negative divergence, and that suggests that this ratio, SPY versus IEF, will be under pressure for I don't know how long, but the weeks to come. And that is corresponding with the weaker rotation for SPY versus GOV, which is right here. IEF is there as well. Making it a realistic scenario that bond markets will continue to rise in the near term. They will outperform stocks. That will cause a rotation of SPY further into weakening towards lagging and vice versa for GOV, with a very good opportunity for both tails to curl inside weakening and back up and roll over inside improving and roll down. That would totally fit in this picture here, with either SPY IEF ratio moving sideways or even moving lower and finding support in that 430, 440 area, digesting that negative divergence. So not too bad for the stock market at the moment. Risks are clearly coming from the bond market, so please keep an eye on that, what's coming there. The good stuff is coming from commodities at the moment. If you look at GSG, we're now clearly back in an uptrend, higher highs, higher lows. This is, if you remember, we look at it on the monthly charts all the time, that very major support level, that rally and the decline, which was to be expected but lasted way longer than I thought it would last, but it looks as if we now definitely formed a low and are now moving higher. And I wouldn't be surprised if in the coming months we're going to challenge that area around 26. We're currently at 22. There's a little bit of resistance here around 23. But you know, all in all, that relative strength line has turned around. Things are looking good versus VBINX. And a similar picture can be seen for DJP, which is also coming out of that downtrend, breaking that downtrend in relative strength and moving higher. And as you can see, the RRG lines have just crossed above 100. So there's plenty of opportunity for both DJP and GSG to outperform VBINX and bring in a nice return in price terms as well. Currently trading around 32.5. I could say that 35.5, 36 is the first level, but we could be looking at, you know, previous peak here, that's around 38, and then the major high that was set at the start of 2022, which is around 40. So commodities are really in good shape at the moment. Now we have Bitcoin, still in that range between roughly 25K and 30, 31, extremes to 32, but still hovering above that major support level. The longer that takes, or the longer we remain here, the stronger the underperformance, as you can see here on the RRG. You can see that big red tail moving into the lagging quadrant. And if we look at that on the daily chart, then you can see how Bitcoin is having trouble leaving that support area. We just put in a new resistance area, 27.5. The positive divergence in the RSI is still there, but it needs to hold. Same for the MACD. I'm a little bit disappointed that we couldn't reach the area around 28, but maybe in the next run. It's going to be a volatile market anyway. We should not drop below 25,000 in Bitcoin. That would really be disappointing and really bad for Bitcoin, but probably also for crypto in general. For the sector rotation, I'm going to break down the universe of the S&P sectors into offensive, defensive, and sensitive. And let's start with the group of cyclical or offensive sectors. And as you can see here, is consumer discretionary is still on the right-hand side, moving through weakening. That's the only one, well, the second one, XLF is just crossing into it, on the right-hand side. This sector has been in very good shape over the last few weeks, has been in very good shape and over the last few weeks rotated out of leading, but it's still in a relative uptrend. If you look at financials, that's been picking up recently. It's crossing over into the leading quadrant right now, but losing a bit of momentum. If you look at materials, it looked as if it was losing, well, it was losing some relative momentum, but it has started to level off and start moving to the leading quadrant again. So the only sector that is really bad inside cyclical, inside offensive, is the real estate sector. That has turned around and is now rapidly moving back towards the lagging quadrant. So all in all, there's not a real clear direction, but if I look at the tails and the setting of these tails, it's not super negative either. And that's the main takeaway for the offensive sector. So a bit of a mixed image, I would say. If we look at the individual charts, they're not looking fantastic from a price perspective, but still, they're also not super negative. If you look at financials here, we broke that rising trend line, but we're now hovering above old resistance, now acting as support. If you look at relative strength, it's moving sideways, still below the lower boundary of that falling channel, which is not super good, but you know, we can go back, and if you look at the RRG lines, then the RS ratio is crossing over into the above 100, while the RS momentum is already there. And that still gives a pretty good undertone. So what I'll be looking at here in the financial sector is holding up 3350. So if 3350 holds in XLF, I think we're still in, not in good shape, but we're in neutral shape. So it can hold up the financial sector and at least be neutral in terms of relative strength, but probably moving further into the leading quadrant. We go to the materials sector, clearly a new period of lower highs and lower lows. We tested that overhead area where clearly a lot of resistance was present, and it looks as if we're now heading for the lower boundary of that range, which is around 74. Nevertheless, relative strength is still holding up above its previous lows, and that is a good thing. If you look at the tail here, we're starting to move towards the leading quadrant again. So in other words, we're picking up relative strength. We're going higher on the RS ratio scale, and we're neutral in terms of relative momentum. Again, that's not as negative as the tail for XLRE. So all in all, it still adds to the kind of mixed, slightly positive undertone for the cyclical sectors. Here's XLRE. As we said, that's very clearly the most negative sector of this group. If you look at this this down channel here, and every time we had a rally and we break lower, and it looked as if we were breaking out of that longer term channel, but when I was annotating this chart, preparing for the show, I had this this song in my head. I think it's an ABBA song that goes like, "Here we go again," like that. It's like, here we go again. The only thing is that we're now very close to longer term support. So I want to see what's happening here. But it's clear that in the near term, XLRE is going nowhere but down or sideways. This is not a very good chart. And if you look at the relative strength, that is very clearly in a downtrend. RS ratio way below 100 and RS momentum rolling over. So this needs to go through another rotation on the left-hand side, back to lagging and then maybe back up into leading. But of this group, XLRE is definitely the worst sector. That is very clear. And now for the last one, that's consumer discretionary. It's the tail that's on the right-hand side. And what you can see here is that, again, not the best of charts, but also holding at support of the previous low. So far, as long as we do that, that's good. All these charts that are holding at previous lows as support, and we break that, there's quite a few potential double tops in the making. So we're at a balancing point for the market right now, both for the S&P as well as the individual sectors. You can see that here for XLY as well. In terms of relative strength, we're still holding up above that breakout level, but we do need to move higher. We do need to see relative strength above 0.4 in order to bring this back up. And that will very likely need prices to actually move higher, preferably going back to those old highs here. For the time being, as long as price holds up above this area, which is around 160, and relative strength holds up above 0.4, the RRG lines will remain positive, the RS ratio will remain above 100, and RS momentum will very likely turn back up. So all in all, for the cyclical offensive sectors, a mixed picture with current strength for XLY, XLF, XLB is picking up, and the only very clear message is coming for the real estate sector, which is rolling over and going down. Now let's move to the group of defensive sectors. As you know, that's utilities, staples, and healthcare. If you look at the RRG, all three on the left-hand side, negative, still persistent relative downtrends. However, they're all going through a period of improving relative momentum. Only healthcare, only XLV is also in a meaningful way picking up in terms of relative strength ratio, in terms of relative trend. Utilities and staples are not doing that. So the main trajectory here is still underperformance for these defensive sectors. Underperformance for defensive sectors is an underlying sign for underlying strength in the stock market as a whole. Usually people flock through defensive sectors when they're scared, when there's fear in the market, when they don't trust the market. You can see that on a minor scale here, but it's not becoming a real full-fledged trend. Until that happens, I believe there's still a positive undertone for the stock market. Another thing is that you can see how these tails are relatively long, but if you zoom in on the later part of those tails, you can see that the RRG velocity, remember the distance between those nodes, is getting shorter and shorter. And that's a sign of the move slowing down. And you will see the same thing here in staples, where the RRG velocity was quite strong, quite big distances here a few weeks ago, and now it's becoming very small. These distances are becoming much smaller. And you can see the same thing, despite the move to the right, that here also the nodes are getting closer to each other. So the power of the move is diminishing. Keep that in mind when you look at the chart of these defensive sectors. So let's start with the utilities chart, and you can see how that is still struggling with that support area. There is the major highs are all coming in lower, indicating selling pressure, and we're playing around with this support area around 63. Look at the relative strength, which is still clearly in a downtrend. There is a little bit of a hiccup in terms of relative momentum. That's what you're seeing on that tail in the RRG. But we need a lot more in order to get the RS ratio back above 100. I don't see that happening anytime soon. So I believe that the utilities sector will remain under pressure. And as long as utilities are under pressure, that is usually a good thing for the market as a whole. Same goes for staples. If we go to the staples chart, you can see that that is under pressure. We broke this support. We're hovering above this support level right here. When that breaks, that's 69.70, so that previous low here. There's way more downside to go to 64. Upside is limited. Look at the relative strength line here. That is clearly in a downtrend, and that is depicted by the move in the RS ratio and the RS momentum lines. RS ratio is stable, moving sideways, at the same level. That's what you're seeing right here. It's moving vertical. That's why that red RS ratio line is moving completely sideways. It remains on the same level. That's this reading right here. And you can see how RS momentum has been picking up, and that is the vertical move on the RS momentum scale. That is now starting to roll over. These distances are getting smaller and smaller, and there is a very good possibility that the XLP tail will roll over inside the improving quadrant and move back down to lagging, putting this defensive sector under pressure again. The only sector showing a slightly different picture, but not much, is the healthcare sector. It's still inside improving, but it looks as if it's already starting to roll over, and we see that here in both price and relative strength. Relative strength is holding up above. That's the reason why it has a stronger tail than utilities and staples, because the relative strength of healthcare has been moving sideways, still pulling up the RS ratio line a little bit stronger, but it needs a lot of work before it pulls RS ratio above 100. And it will be difficult with a price chart that looks like this, kind of going nowhere. Maybe a range-bound pattern is probably the best that I can make out of it. There is certainly not a very strong move coming in the healthcare sector at short notice. At least I can't see it in these charts. So the overall conclusion for the defensive sector is that it is still the defensive sectors, I should say, that it is still under pressure, that they are still in relative downtrends. And when defensive sectors are in relative downtrends, again, that's usually a positive undertone for the market as a whole. We don't see it at the moment, but this is what the sector rotation is telling me. And then finally, the group of economically sensitive sectors. And that's interesting because if you look at this RRG, it doesn't look that bad. If you look at energy, long tail powering into the leading quadrant. Look at communication services, strongest rotation that we know. Inside weakening, but already starting to move back, picking up momentum and move back towards the leading quadrant. And technology, inside weakening, still moving lower on the RS ratio scale, but it's leveling off. It's losing its downward relative momentum, and the RRG velocity, the distance between the nodes, is getting shorter and shorter. Look at how that XLC tail, how these nodes are really close together. The only one that's really bad, or the worst on this graph, is XLI, which is rolling over inside the improving quadrant and heading towards lagging. However, it's very close to the benchmark, and we know that sectors that are very close to the benchmark are kind of moving in line with the benchmark. So that's the S&P at this stage. Let's look at a few of these individual charts. So here is energy. And as you can see, that is a sector that is pushing to new all-time highs. It's still playing around with that overhead resistance around 91.5. But I really like the relative strength of energy coming out of that little setback here, moving higher, pushing both RRG lines above 100 and playing around with your all-time high levels. That is a pretty good sign. That is a strong sign. If we can take out these highs here above 91 and the extreme will be 92.5 probably, that will really confirm the underlying strength for the energy sector as a whole. The tail obviously really strong on the RRG. If you look at XLY industrials, that is the weakest sector on this graph here. And as you know, this was breaking out to all-time highs. We dropped back below it, but the relative strength is going sideways and it's pulling the RRG lines lower. It looks as if the RS ratio line has set a peak below 100 and the RS momentum line is dragging it down, and that's causing that tail to roll over inside the improving quadrant. You can see how the sideways move is indicating a move in line with the benchmark, almost zero there. We probably need to hold up above, let's say, 100 in XLI to kind of keep a status quo where we are right now. Difficult chart to read. We definitely need to find out where this new low, if it comes, will be. If it's above 100, I'm still pretty good with that because we can start building a base and see if we can really push the sector above its previous all-time highs. Right now, near term, neutral, sideways at best, I would say. And then here is technology. Again, a sector that pushed to all-time highs here, fell back, but we're holding up above support. That's pretty much in line with what the S&P is doing right now. And you can see that back here in the the raw RS line, which is holding up above its breakout level, moving sideways right now. That's causing the RRG lines to correct, but you can see how the RS momentum line is starting to move sideways already. So if this process continues and XLK can hold up above 160, preferably put in a new low and start moving higher, dragging the RS momentum, dragging RS relative strength higher, that will cause RS momentum to start picking up momentum and hopefully put in a new low in the RS ratio line above 100, which would cause XLK to actually curl back up within the weakening quadrant. It's a bit of, trying to look ahead and paint a scenario, but I think it's a realistic scenario. XLK still has a bit of room to move before it really hits support, and that would be just enough for that relative strength line to move higher and take out the previous highs, which is above 0.4 for XLK. And then the final sector in this group is XLC, communication services. It's breaking this rising trend line, so again, not the strongest of sorts. But look at the relative strength here. That is really strong. That trend is intact. It's moving higher. It's actually penetrating its previous highs. And you can see how that is translating in an RS momentum line that's already curling back up and ready to move above 100, which would put XLC back into the leading quadrant and moving higher. So all in all, as I said throughout this whole show, I think it's a market that is at a very crucial level. If the weakness in cyclicals, or if there really becomes weakness in cyclicals, then that would be threatening the S&P. If the head and shoulders pattern plays out, we've got 30 points of downside, potential downside in the S&P 500. But the defensive sectors are not playing their part at the moment, and if you look at the sensitive sectors, they're actually not too bad. They're dominating the right-hand side of the graph: energy, communication, technology. We do need a little bit of move upwards. We do need a little push from the price perspective, but when that comes, this market is not in too bad of a shape. That will all change when defensive sectors start to pick up a lot of relative strength and move all towards that leading quadrant, and the cyclical sectors will rotate back down, and this group of economically sensitive sectors, especially technology, will move towards the leading and into the leading quadrant with industrials as well. I hope that we will find some clues. The market will give us some clues in the next few days, next few weeks, but otherwise doing nothing or being very careful or and remaining close to home with your positions is also a decision. It's also a position. You don't have to trade. So I want to leave it at that for this week. And I also want to announce that next week, the next 2 weeks actually, will also be pretty hard for me to record Sector Spotlight, because I'll be traveling to really far away, Jakarta, Indonesia, to do a talk on RRG for the IFTA conference, which will be held there. That's the annual IFTA conference. I'll do my best to maybe do a very short show in my hotel room on a laptop. It will probably not be looking as good as when I'm at my own rig here with all the production facilities. But let's see what I can do. I probably can do a written article as well. And other than that, I'll hope to see you definitely in 2 weeks' time, but hopefully in 1 week time at a new episode of Sector Spotlight. I hope you enjoyed the show. I'm looking forward to seeing you again in a couple of weeks' time, same place.